Welcome to our lecture on financial management. Today we will talk about portfolio allocation, a crucial concept in portfolio management. Let's begin. An investment policy statement is a foundational document that guides an investor or institution in managing their assets. It establishes clear guidelines for decision-making, portfolio construction, risk management, and long-term strategic direction. Investment policy statement typically outlines investment objectives like growth or income, time horizon, risk tolerance, and liquidity needs. It also considers tax implications, ethical constraints, target asset allocation, and rebalancing rules. For an individual investor, an investment policy statement might target long-term growth for retirement with a moderate risk tolerance over 25 years. This could translate to an allocation of 70% equities, 25% bonds, and 5% cash. Portfolio allocation is the strategic distribution of an investor's assets across different asset classes to optimize the balance between risk and return. Major asset classes include equities, fixed income, cash, real estate, commodities, and alternative investments. There are three main philosophies: strategic, tactical, and dynamic asset allocation. Strategic asset allocation is a long-term, stable approach based on the IPS. Tactical asset allocation involves short-term adjustments based on market outlook. Dynamic allocation automatically changes with market conditions or investor life stages. Examples of strategic allocations range from conservative, with 20% equities and 60% bonds, to aggressive, with 80% equities and 20% bonds. Over 90% of long-term portfolio performance is determined by asset allocation, not by picking individual stocks. Diversification reduces unsystematic risk, and proper allocation helps reduce emotional decision-making. Portfolio rebalancing is the process of adjusting a portfolio back to its target allocation after market movements cause drift. For instance, if a target of 60% equities and 40% bonds drifts to 75% equities and 25% bonds after a strong market, the portfolio becomes riskier. Rebalancing methods include calendar-based, threshold-based, or a hybrid approach. Benefits include maintaining consistent risk levels, preventing extreme portfolio positions, and encouraging investors to buy low, sell high. Life stages significantly influence portfolio preferences, as financial needs and risk tolerance evolve over time. Early career investors in their 20s to 30s prioritize growth with high risk tolerance, often allocating 80 to 90% to equities. Mid-career individuals in their 40s to 50s focus on growing wealth with moderate risk, typically 60 to 70% equities. Pre-retirement emphasizes stability and capital preservation, with 40 to 50% equities. Retirement prioritizes income and principal protection, often with 20 to 40% equities. These principles, investment policy, portfolio allocation, rebalancing, and life stage adaptation form the foundation of disciplined, long-term financial management. Understanding and applying these concepts is essential for college students to build a secure financial future. Thank you for watching our lecture on financial management, focusing on portfolio allocation. See you at the next lecture.